So today we're going to spend about an hour talking about estate planning for a loved one with special needs. And a question I get often is, what does that mean? Why do we need to plan differently maybe for somebody with special needs? And generally, it's really about enhancing their quality of life to the maximum extent possible. So for a lot of individuals, when we're doing an estate plan for somebody with special needs, it used to be that we didn't have to do much estate planning because of where we were with our medical knowledge at the time, because oftentimes people with disabilities did not survive their parents. Now, with the advances in medical technology, most or many people with disabilities are living full life expectancies, out surviving their parents by many decades. So, what we're trying to do when we're doing estate planning is generally we're working with mom and dad to set up a trust for their loved one with special needs, and hopefully that trust will last throughout their whole lifetime. But what makes this different than like doing an estate planning for a couple or an individual is we're really creating a more comprehensive, or what we call holistic plan, because part of the special needs trust is, of course, to provide financial security. And the reason we need to provide that financial security is that when we're talking about people with special needs or people who are disabled, we're generally using the definition that the federal government has provided. And that definition really is based on a physical or mental impairment that will last for a long time, typically throughout their lifetime, that prevents them from going out and getting a job and earning money. And because they have a fairly substantial disability that prevents them from engaging in substantial work, oftentimes the money we're leaving them in a special needs trust is really the only money they're going to have available to them other than what the government provides. And we don't want whatever we're providing to that loved one with special needs to interfere with their eligibility for these public benefits, because we need the benefits and we need the private money, and we need to combine those two to provide a lifetime of care for that person with special needs. So the benefit here is that we set up, a trust for financial security that does not interfere with public benefits. Part of the planning that we have to do is, making sure that we have the right people named in how to administer that trust for their lifetime. And then typically when the parents come into my office, they're worried about more than public benefits, and they're worried about more than, making sure the trust is set up correctly. They want to make sure that their loved one has housing, advocacy, caregiving, and they want to coordinate everybody's plan together to make sure that we're not interfering with that loved one's eligibility for benefits, and also providing a solid plan for their caregiving. In addition, because many people with disabilities have impaired capacity, diminished capacity, or no capacity at all, we want to make sure they're protected against any financial predators. And we also want to make sure that we're setting up the plan so that the proper heirs will inherit the money after that person dies. So generally, when we're talking about special needs planning, it's more than just a trust document. It's more than just having a quick meeting and hitting a button in our estate planning software. It's more of a discussion with the parents on how they envision their loved one, living for the rest of their life based off whatever money we can leave them. So this is what a special needs planner will do. And one of the big components is making sure that we have preserved their eligibility for public benefits. So this chart provides, a basic summary of the fundamental public benefit programs for people with disabilities in California. So you'll see it's divided up into needs-based, entitlement, and then other benefit programs. Needs-based means to be eligible for these programs, the person has to be disabled, but they also need to be poor. They have to have a need for this benefit. The big one is supplemental security income, or SSI. It's really the foundational program for a lot of people with disabilities. We'll talk a little more detail about that in a minute. In addition, with SSI, which provides a monthly financial check, Medi-Cal is the healthcare that a lot of people with disabilities rely on entirely to provide all their healthcare needs. So SSI and Medi-Cal both have some financial requirements that have to be met in order to qualify for those programs. Part of Medi-Cal is in-home supportive services, or IHSS. What that provides is the government will help pay for a caregiver so that that person can remain at home. It's a really excellent program for many of our clients. It allows them to reside in a community, whereas if they did not have the IHSS worker, they might end up in a facility. So it's a really good program. Again, it's not perfect. None of these programs are perfect, but they all provide assistance for that loved one with special needs. The next section is really the entitlement public benefits. These are programs that people have paid for, usually by working, that qualifies them for these programs. One is Social Security Disability Insurance, or SSDI. This is a program where you as a worker have been paying into the system every time you get a W-2, and part of that you'll see is a withholding for SDI. And that's what you're doing, is you're paying for a disability insurance policy so that as long as you paid into the system long enough and then you became disabled, then you would qualify for SSDI. They don't care how much money you have in your pocket, in your name, or whatever. As long as you qualify as disabled, you receive SSDI. Childhood Disabled Beneficiary Benefits, CDB benefits, formerly known as Disabled Adult Child, or DAC benefits. You still hear it referred to that as DAC every once in a while. This is a very misunderstood and in my opinion, often missed program for people with disabilities. What this program allows for is if somebody's disabled before age 22, and if their parents have paid into the system long enough, and then that parent either retires, becomes disabled, their child who's disabled would receive 50% of what the parent receives under their SSDI check, their Social Security Disability check. And if that parent then dies, then the child would receive 75% of what the parent would receive. Again, this is a really good benefit because usually it's much more than what SSI pays, but it also does not have a needs-based component, meaning that it doesn't matter how much money the person with a disability has in their name to qualify for CDB benefits. So it's a really good program. The benefit of SSDI and CDB benefits are if you're on those programs for at least 2 years, you'll also qualify for Medicare. So Medicare is the other government-sponsored program for healthcare. Generally, and I mean generally, Medicare provides a little better coverage because it has access to more doctors and hospitals, more people accept it. But understand that Medi-Cal will pay for certain things that Medicare does not. So it's important to make sure that your person is getting qualified for as many public benefit programs. And it's possible they could qualify for both Medicare and Medi-Cal, which is something that we try to do if we can. There are certain other benefit programs. If the person is developmentally disabled, meaning that they have a disability from birth, usually like autism, Down syndrome, cerebral palsy, some kind of intellectual disability from birth, then they can qualify for regional center benefits in California. It's a really excellent program that a lot of families use, to allow their individual with developmental disabilities, to have basically somebody there looking out for them, from birth to death. Sometimes parents come to me and they're like, well, I don't get much benefit out of the regional center now. And a lot of times that's because until they're out of high school and getting their supplemental services through education, regional center really doesn't have to do much, although some clients use it quite a bit. After high school, after schooling, mandatory schooling, oftentimes regional centers will provide some transitional programs, some individual programs to allow people to live independently. It's a really good program, but you have to access it and you have to advocate for it. There are also Section 8 benefits. That's the Housing Choice Voucher Program. It allows the government to help pay for rent. And a lot of times people with disabilities can qualify for a Section 8 voucher under a reasonable accommodation. Sometimes it takes many years to obtain a Section 8 voucher, but once you do, that means the person only has to pay 30% of their income on rent, and then the government will pay the balance of the rent. And it's again another way to find a source of revenue to help living expenses throughout that person's lifetime. And finally, there is a veteran benefit program, which again, if the person's disabled through either a wartime injury or while they're a veteran, there may be veteran benefits available to them. Or if their parent was a veteran, sometimes the disabled children of veterans can qualify for different programs. So again, it's important to understand this tapestry of the different public benefit programs, because certain of these programs absolutely require a plan. Some of them don't require much of a plan. So it's important that you understand. If you ever find yourself wondering if you have a question about a public benefit, I have to tell you this website, Disability Benefits 101, is excellent. It has a California specified webpage, and they keep their information incredibly up to date. And they do an excellent job explaining the different requirements for each of these types of public benefit programs. Okay. Now, let's look into SSI a little bit more. So understand that supplemental security income, the person has to meet two basic tests. They have to be disabled and they have to be poor. So to be disabled, that's that physical or mental impairment that will last for 12 months or longer that prevents them from engaging in substantial gainful activity, which is a fancy way of saying that they're disabled and they cannot work. And basically the test for work is, can they go out in the workforce, in their community, do anything and earn up to 1,620 bucks a month. That's in 2025. So if they can do that, they're not disabled. They could, they might be in a wheelchair, but they might be able to work, as a programmer for Apple. So under the government's definition, that person would not be disabled because they can earn. So once you meet that definition of disability, then they have to make sure that you're poor. And the way they do that is there's a resource test, and that resource test is you can have no more than $2,000 in your name. And there's an income test, and income is defined differently for SSI than it is for like IRS. So it's a common misunderstanding here where when we hear the term income, our minds immediately go to the IRS and how they define income. Understand that each one of these public benefit programs has their own definition of income. And we'll show you some of those differences here in just a second. But let's assume that you do qualify for SSI. What do you get? Well, you get a check. And right now in California, the maximum check is $1,206.94 a month. And that's basically for an individual living on their own. And that's how much they would receive. Part of that check is federally based. So 967 comes from the federal government. And then California supplements that. So in other states, they only have the federal benefit portion. So many states, you'll only qualify for 967 a month. And again, here's that definition of disability that I just mentioned. Again, it has to be substantial gainful activity, which is the ability to go out and work. And you'll see this a lot on commercials. If you ever see late night TV and somebody's saying, have you been denied your disability? This is the definition they're talking about, because they'll look at somebody's condition and find out, does that condition prevent them from going out and finding meaningful work? And that's what this definition is concerned with. It's the same definition for Social Security disability insurance. So SSDI and SSI have the same definition of disability. But SSI has a resource test. As I mentioned, it's $2,000 for an individual. If that individual gets married, then the married couple can only have $3,000. Now, not every resource is counted. So for example, their primary residence of any value is exempt. An automobile, as long as there's only one, is exempt. All their personal belongings, furniture, clothing, any personal care items, also exempt. Certain burial plots, life insurance, only up to a certain amount are exempt as long as they're revocable. If they're irrevocable, it can be any amount. So again, that's not a big number. $2,000 resource test. It doesn't take a lot to get over $2,000. And that number has not changed since 1984. So, and I don't see it changing anytime soon as to the eligibility for the asset test for SSI purposes. So that's the easy test. If you're over 2,000, you do not qualify for SSI. If you're under, then you possibly do qualify. But then they have to look at your income. And remember how I said it's different than IRS. So there is an IRS component, which is what they call earned income. And that's basically what we think of as income. However, for SSI, they also have one called unearned income. This is basically if somebody's on SSI and you're like 1206.94 a month in California to pay for all my food, clothing, shelter, medical care, living, any type of enhancements to quality of life. That's not a lot of money. I'm going to give that person $1,000 stipend. I'm just going to give them cash directly to so they can have 2206.94 a month. The Social Security Administration counts that as unearned income because somebody gave them cash. They're like, why should we continue to give cash if somebody else is willing to give this person cash? So they'll reduce that SSI check dollar for dollar after $20. They have a little exemption amount. Then there's in-kind income, in-kind support and maintenance. Now, it used to be if somebody gave somebody on SSI food, clothing, shelter, they would reduce the SSI check, but they've now taken food and clothing off the list. So we're just dealing with shelter now, and I'll talk about that a little more. Then there's something called deemed income. And deemed income is based if somebody else has income and they're obligated to support you, their income and resources are going to be counted against you. So minor children who have parents, the parents' income and resources count as the minor child's. If that person gets married, the spouse's income and resources are counted towards the spouse. Okay. So remember how I said there's certain exempt income, like remember how I said there's exempt assets like a house, a car, certain personal belongings. There's some exempt income not quite as valuable as a house or a car. So for example, remember I had the example of somebody giving them $1,000. Well, the first $20 of that 1,000 is free. And then the $980, this is where they would start deducting the SSI check. Now, earned income, this is when they go out, they get a job. Let's say they earn $585 in a month just working. And instead of a dollar for dollar reduction, for every $2 you earn, you lose $1 of your SSI check. So in this example, that SSI recipient is able to get a job. Now remember, maybe it's not enough for substantial gainful activity, but they might have a part-time job, a supported workshop where they're getting a little bit of money. They get $585 in the month. Well, 20 of it is free. That's that any income disregard. The first $65 of earned income is free. So there's $85 free. But for every $2 earned after that, they lose $1. So in this example, they go out, they earn $585. We reduce the 85 exemption and you divide that in half. So this person would lose $250 from their SSI check. So again, it's better than if they hadn't worked at all, but it's not as valuable as getting the work and the SSI check. This is the SSI unearned income, which is the really tricky part. Unearned income is that dollar for dollar after that $20 exemption. And that's what I gave the example of 1,000. But if the parent give a child $585, you can see they're going to lose 565 from their check. So giving cash to an SSI recipient is never a good idea. What you could do is you could pay for things directly. If you want, instead of giving them 585, pay for a trip or an item, a TV directly. Don't give them the cash to buy it. Otherwise, that's going to count as unearned income. SSI, in-kind support and maintenance. Now, as I mentioned before, clothing and food used to be included. Food was just taken off last September, so it's still relatively new. And it's a real benefit because, again, trying to pay for all the groceries and everything with the $1,206.94 a month, plus their rent and everything else, didn't leave a lot of room. So now, basically, there's only shelter, and shelter consists of like rent, utilities, electric, water, gas, most of the main utilities. And if you pay for that, then what happens is they reduce the check, but not dollar for dollar like with unearned income, or they deduct it $1 for every $2 for for earned income. Instead, they create a formula and they take 967, divide it by 3, and 967 is the federal benefit rate. Remember, that's how much the federal government is paying towards that check. They reduce it by 1/3, and then depending on how they're living, they either just take that third and deduct it from the check, or if they're living on their own and some third party not living with them is paying, like say the trustee of a special needs trust or a parent for a kid living in their own apartment, they would take that 1/3 and add $20. So basically, I think it's around, if my math is right in my head, about $324 a month. So if you provide all the shelter for an SSI recipient, they're going to lose about $324, $344 a month, depending on how they're living. So those are income rules. And then the final income rule is deeming of income. So again, as I mentioned, a lot of my families come to me with their children still a minor and are wondering why that child doesn't qualify for SSI. That's because they look at mom and dad's income and resources, and if they're over those minimums, then they're going to be disqualified. When that child turns 18, then they look to the child's income and resources to see if they qualify for SSI. So it's important that we don't leave money directly to a person with a disability who wants to qualify for SSI, because that money will disqualify them from SSI. And it doesn't even matter if that person is willing to spend the money on their children or their spouse. As long as they have it, it disqualifies them from that program. So a quick question, does Section 8 count as in-kind income? No, it does not. And there's some longer questions that I'll get to later here. Let me kind of get through some of this because we're already almost halfway through. So Social Security Disability, SSDI, remember how I mentioned it, as long as you work, you pay into the system. And if you paid enough into the system and then you become disabled, you qualify for SSDI. After 24 months on that, you would qualify for Medicare. This is that program that I recommend for all my clients to look into. So if they're disabled before age 22, the parents worked, then they can qualify for 50% of what the parents receive, as long as that parent is retired or disabled, 75% after they die. The issue for the child is not only do they have to be disabled before age 22, but they can never have worked at substantial gainful activity, and they can never have been married. And there's some rules around that. But if they do qualify, it usually is a really good benefit that provides more money to them and gets them access to Medicare. And as I mentioned, Medi-Cal and Medicare, they do provide the general coverage, but the two things that Medi-Cal pays for that Medicare doesn't is long-term skilled nursing care and also in-home care. So that's that IHSS program with the caregivers. Medicare doesn't really provide for that. They provide a little bit, but not very much. So Medi-Cal is very important for many of our clients. And again, Medi-Cal in California, if you qualify for $1 of SSI, you qualify for Medi-Cal. But some people might have, like, say, Social Security disability that disqualifies them from the SSI program. So there's other ways to get Medi-Cal. So in California, we have something called Magi Medi-Cal, and they just look to see if your income is below 138% of the federal poverty limit, which in 2025 is for an individual $1,801 a month. If they earn less than that per month, they could qualify for free full scope Medi-Cal through Magi, as long as they're between 18 and 65 and they don't qualify for other insurance. So understand there's a lot of details here. Medi-Cal has always had an asset test up until last year, where it eliminated its asset test, but there's still an income test. And so it's important to understand that if the person has money in their own name and it's earning income, then that will, and if it goes over the 1801 a month, it's going to disqualify them from free Medi-Cal. And they're going to have to start paying for Medi-Cal based on how much income they have. So a lot of our planning is around, we don't want to trigger income to an SSI recipient if we can avoid it. It's always important to qualify for the right healthcare program. And in California, you should go to Covered California. This is, again, they'll do an evaluation to see if you qualify for Magi Medi-Cal, or if not, if you qualify for one of the other Medi-Cal programs. And if not that, then they usually have low cost insurance available to many people. You should also have them check their My Social Security account, because the one thing you're going to find out is when you're dealing with families, oftentimes they have no idea what public benefit program they're receiving. Because think of it, SSI, SSDI, two wildly different programs with different eligibility requirements, but they're run by the same agency, the Social Security Administration, and they check comes from the same place. So it's very rare that they know exactly what benefit they're on. If you get them on the My Social Security account, they can send a benefits verification letter so you know exactly which program that you're planning for. Okay? Now, somebody asked if you apply for SSI, is your application automatically tested for SSDI? Yes. Again, it's probably the other way around. You're probably going for SSDI and then they'll qualify you for SSI, because SSDI requires that you work for a long period of time before you can qualify for that. Are we able to access a seminar later? I don't know that. Maybe we can find out. If not, if people want me to revisit this seminar, I've done this many times and I'm happy to do it again. All right, let's get into special needs trusts. So there's a legal toolbox here. How are we don't want that person with a disability to receive cash or have money in their name and disqualify them, say, from SSI, or have countable income that might disqualify them from Medi-Cal or some of these other programs. But we also are looking holistically, because what if that person with a disability doesn't really have the capability of making their own healthcare decisions, their own living arrangements, they're not able to protect themselves. So they may have capacity issues. Now, up until age 18, mom and dad have the legal authority to make their decisions for them. At age 18, no matter how impaired they are legally adults, and parents now have lost their right to make legal decisions on behalf of their children. Practically speaking, most healthcare providers and others will still look to the parents to be making decisions. I've had clients come to me when their children were in their 40s with zero capacity, never having had an issue with this. But again, understand that at some point, somebody may question the parents' right to make decisions. And if you don't have a legal document or legal support that authorizes you to make those decisions, you don't have that right. Again, every person with a disability is different. So every plan is slightly different. So if they turn 18, maybe they do have capacity, but maybe it's not, full capacity to say go out and get a job and earn a fair wage, but they have enough capacity to know how to protect themselves and a general understanding of, appointing people to help represent them. And so for those people, if they turn 18, I usually recommend to the families that they get their children to sign a power of attorney and an advanced healthcare directive where they would name agents to make decisions for them if they lost the ability to do so in the future. Sometimes they just need support. Like they don't really need a full agent or a conservator. And if they do, then sometimes a supported decision making arrangement will work. This is a relatively new law in California. Um, it basically is kind of an arrangement that's set up with the person with special needs, with their family, and they're setting up a contract for, this is the assistance I need. This is all the assistance I want. There's also an ABLE account, which is a special account that people with disabilities can set up and put money in, and it won't count against them for eligibility for any of these other public benefit programs for SSI, SSD, Section 8, any of them. Every public benefit program recognizes ABLE accounts as exempt. There's some limitations that we'll talk about. Generally, when I'm talking to parents or grandparents or anyone who wants to leave money to a person with special needs, the special needs trust is kind of the foundation of the plan. This is where all the instructions go on what they want done with this money to help enhance that person's quality of life for the rest of their life. If at age 18, the person really doesn't have capacity to manage any of their affairs, they don't have the ability to contract to do a power of attorney and advanced healthcare directive. They can't really participate in a supported decision-making arrangement because they completely lack capacity. You might need to file for conservatorship. And so conservatorship means that you're appointing someone to make all their decisions for them. And it's really broken up into limited conservatorship and general conservatorship. We'll talk about that in just a sec. So for that power of attorney, they do have to have capacity to contract. And again, the benefit of having a power of attorney is you don't have to go through an expensive conservatorship later if they end up needing somebody to make legal decisions for them because they've lost the ability to do so. But when they sign the power of attorney, they have to have had the capacity to contract to do that. Now, the downside of a power of attorney is they can also revoke it at any time. So it's not bulletproof protection. But again, as long as you follow the execution rules, you can get a power of attorney signed. They can name an agent. I usually recommend naming successor agents if that agent cannot serve. Who's the next best person? Who's the next best person? The benefit is that, again, we'll talk about conservatorship, but it can be expensive and it's a little difficult to obtain these days in California. The advanced healthcare directive is just the power of attorney, which, deals with financial decisions. It deals with housing, residents and stuff like that. The advanced healthcare directive deals with healthcare decisions. And again, they can just name the people that they want to serve to make healthcare decisions for them if they're no longer able to do so. The same thing, they have to have the capacity to execute an advanced healthcare directive. As long as they did, and then later they lose capacity, then their agent can make these decisions. As I mentioned, the supported decision-making process is a little, it's recent, so I haven't seen a lot of testing of the system here, like what happens if somebody ignores their supported decision-making arrangement, what's the penalty for that? But again, it's a separate kind of process where they enter into a contract where they make agreements on they'll support that person with a disability, but they're letting the person with a disability make their own decisions. Now, I mentioned ABLE accounts. So these have been around for a few years now. And if you're familiar with 529 plans, which are accounts set up for education, You put the money in, it grows income tax free, and then you pay for higher education and it comes out income tax free. Well, the ABLE account is based off 529 plans. It's actually under IRS code 529 capital A, 529A. And people with disabilities or others can fund an ABLE account. The money in that ABLE account does not count as theirs for that $2,000 resource test. Any income earned inside the ABLE account is earned income tax free and doesn't count against their income test for any public benefit program. As long as they make expenditures for qualified disability expenses, then it comes out income tax free. But to qualify for an ABLE, the person has to have been disabled before age 26, and that age will go up to 46 in 2026. So right now, though, to use an ABLE, the person has to have been disabled before age 26. You then select the appropriate state plan. So California has the Cal ABLE program. It's a great program, and I would strongly recommend looking up Cal ABLE. The big limitation is you can only fund it this year up to $19,000 from all sources. Okay, so it's tied to the annual gift tax exemption amount that the IRS issues each year, but it's just one. It's like for normal gift tax, you can have multiple people giving 19,000. Not for an ABLE account. You can only have a total of 19,000. As I mentioned, once the money goes in, it grows income tax free. Money goes out, qualified disability expenses. If it's not a qualified disability expense, there's a penalty. But the IRS has been very generous in defining what a QDE is. They basically say it's just about anything. iPads, all kinds of things. So it's very rare that you can ever find any issue with, an unpermitted distribution from an ABLE account. The ABLE account is exempt. So all the money in there is exempt. It grows, it's exempt. However, once it reaches $100,000, it would suspend SSI. It doesn't eliminate SSI like you would if that money was in their name, directly. But as an ABLE account suspended, then if you spend it down below the 100,000, then they get the SSI back. Okay, so the idea is it's allowing people with disabilities to save and their own money. They can be in control of their own ABLE account if they're able to manage money. It's a nice way for them, to have more than $2,000 in their name. You can always move to a different ABLE plan if they want. Now, by law, there's supposed to be a payback to the state Medi-Cal agency on death, meaning if they use Medi-Cal during their lifetime, then the ABLE account has to be used to pay back whatever was, Medi-Cal spent on their behalf. However, California has passed a law that says they are not enforcing that. So there's no payback in California if you use the Cal ABLE program. Okay. The other big thing here is the special needs trust, and it's the best method for leaving an inheritance to a person with a disability. We call it a third-party special needs trust because it's being funded with other people's money other than the person with a disability. If the person with the disability has their own money, you have to use a different kind of special needs trust we call first party, and it has much more stringent rules. Third party is not so bad. Basically, the beneficiary cannot have the right to revoke that trust, and the beneficiary cannot force distributions out of that trust for their own support or maintenance. But there's nothing that says that you can't have a fully discretionary trust with a trustee paying for support and maintenance items, but you just can't make it mandatory or a requirement. So you can't use what we call in the estate planning world the HEMS standard, health, education, maintenance, support. Instead, you have to make it a fully discretionary trust, meaning the trustee has discretion to make a distribution or not make a distribution. Historically, people were, scared to leave any money for the benefit of a person with disability. So sometimes you'd hear people say, just don't give them money, just inherit them and give it to a, family member and ask them to take care of that loved one. Problem is, that person may decide I'm just going to use the money myself. There's no legal requirement that they use it for their loved, their sibling with special needs or whoever. But they could also be subject to their own creditors. They might get married and divorced, and it might be subject to a divorce marital property agreement. So again, putting it in a special needs trust sets it aside legally for that person with a disability. And as long as it's set up so it's not revocable by the beneficiary and the beneficiary cannot force distributions for support or maintenance, it's exempt. So it does not count against them for public benefit purposes. Now, the beneficiary cannot have the right to revoke that trust, but if parents can. So when I set up a trust, I usually set up a living special needs trust. It's in existence now. And I usually have the parents as trustees with no money in the trust. It's just there, with the parents as trustees, they have the right to revoke that trust. And the reason is if there's other family members or friends who want to leave money to that person with a disability, there's a place to put it. Plus, we want to make sure that that special needs trust is in a perfect, that all the provisions in there are focused on that person with special needs, because some people will put it into living trust or a will and say, on my death, set up or create a third party special needs trust. That works, but that's called testamentary, which means it doesn't exist until the person dies. So if parents are still alive and other people, family members want to leave money to that special needs trust, they can't do so because it's not in existence until the parents die. You create a living special needs trust or somewhere to put the money. The other thing is if you put it inside a living trust or a will, a lot of times the provisions in there are designed for what happens when mom and dad die, who gets this, who gets that. The trustees are usually, older. And again, there's usually not a long list of trustees. Remember, with a special needs trust, the administration could last for decades. So we need to build in provisions for a decades-long administration, which means how do we replace trustees? And we'll talk about what I consider the ideal trustee, because it's different than managing a living trust. They have to understand all the laws on how to manage a trust, but they also have to understand the public benefit rules, and they change regularly. In fact, we'll probably be getting a few more changes in the next few years, I can assure you. And it's always important to stay current with what you can and can't do as an SNT trustee. You want to make sure that trustee is always acting for the benefit of the beneficiary. There's no self-dealing. You want to make sure they understand how to invest the money. They make tax efficient decisions on property. And if they hire caregivers, there's a whole, caregiver expense that they have to deal with. They have to keep perfect records and books. They have to be insurable or have deep pockets, because if they make a mistake, they could be on the hook for refunding money to this trust. They have to understand services for people with disabilities and recognize second-rate services so they can, do something about that. A lot of times the trust will own the family home, and you want to make sure they understand real estate and taxes, maintenance, upkeep. They oftentimes have to hire care managers and caregivers, which can be a whole other responsibility. They really need to be good communicators, especially when you're dealing with somebody with special needs, or maybe you're dealing with their family. It can be important that they be able to say no appropriately, because sometimes you have to say no, and that can be a challenge because most people in my practice are trying to do the right thing, and a lot of times they just want to say yes, but sometimes saying no is the right thing. And it always helps for that person to be psychic, immortal, and omniscient, because if you hit all those things, you have the perfect trustee. Problem is, I've never found that human being. So what I recommend generally is breaking up the SNT management team into a trustee. It can be an individual, but I generally recommend professionals, either a corporate trustee or a private professional fiduciary, which is a licensed profession in California, and many individuals specialize in serving as trustees of special needs trusts. Many of my family members are concerned, though. They're like, well, there's a professional now in charge of all this money. They're going to be making decisions about my child with special needs, and they have sole and absolute discretion to decide how to spend money. I'm a little worried about that. So that's where we put family members and friends on a trust advisory committee, and we let them have the authority to remove and replace that trustee at any time for any reason. So it's a check and balance over that trustee. And again, there's always things that can go bad, go sideways. But again, I generally find that this management team works very well. Sometimes the advisory committee, we try to get 3, 5, 7 people on there, and then we allow them to appoint their own successors, because again, thinking of those decades of administration. But what happens if, like, once the trust is irrevocable, usually after the second parent's death, what if they change the laws in 5 years? Well, if they do, then we have a trust protector in place, and that trust protector can modify the trust to keep it current with any changes in the law. So it's a really it's a really good way, I think, to manage a trust. Is this the only way? Absolutely not. I find that siblings that tend to make the worst trustees of special needs trusts. A lot of times they have their own family, and the last thing they want to do is manage their sibling with a disability's money. And a lot of times they have a hard time following the rules because they have to keep up with the public benefit rules. And sometimes they just resent the whole thing. And sometimes the person with a disability resents having their sibling be in charge of their money. So siblings are great on the advisory committee. I don't think they serve well as trustees. I'm sure there are exceptions, but in general, that's been my experience. Now, part of doing a special needs plan is making sure you have a special needs planning attorney, or oftentimes you also need a special needs financial advisor. So this organization called the Academy of Special Needs Planners has attorneys from around the country who all specialize in this area of law. And there's a good website, specialneedsanswers.com, that has a lot of answers to questions that a lot of people have on different aspects of special needs planning. So I strongly recommend that. Now, understand that the Special Needs Trust will have language so that it doesn't interfere with public benefits eligibility. It talks about enhancing the quality of life of the person with a disability, but it says use this, sole and absolute discretion of the trustee, with maybe the advice of the advisory committee to decide how to spend money. Even with all that, you don't want to put a lot of specifics in your trust, because what makes sense in the year 2025 may not make sense in the year 2045. So what I tell my families is, let's create a memo of intent, or a memorandum of intent. This is where mom and dad, again, understand that they're going to know more about that loved one with special needs than anyone else on the planet. And we want to get some of their knowledge down on paper. And that's what a memo of intent is really good for. And I put in my special needs trust, if the parents have left a memo of intent, trustee and advisory committee review it, take a look at it, let us know what you think. It gives kind of them something to look at in deciding, does this make sense to make a distribution, or does this not make sense to make a distribution? So I always recommend this. Now, I've been recommending it for years, and a lot of times my clients just wouldn't do it because it's hard. I have a daughter with autism, and I tried to do this myself, and it's a very challenging document to put together. So my wife and I created a workshop. It's complimentary. You can access it here, and it's 1 hour, and I give it to my clients. I let them take a look at it. It has 1 hour of things to consider, and then it has some fillable PDFs to get them started. So I think the memo of intent turns out to be probably the document most people refer to the most, depending on how much work the parents put into it. So it is a very, very important document. Okay. So I mentioned conservatorship. So this is when the loved one with special needs turns 18, and the parents no longer have the legal right to make decisions on their behalf. And if that person does not have the capacity to do a power of attorney, an advanced healthcare directive, doesn't have the capacity to create a supported decision-making arrangement, and the parents need to be there because this person is vulnerable and they need protection. if they're developmentally disabled, autism, uh, cerebral palsy, Down syndrome, then you can qualify for something called a limited conservatorship. And the limited part doesn't mean that the conservatorship, is restricted. What it means is some people with developmental disabilities, they may not be able to make healthcare decisions, but maybe they can make their own education decisions. So you pick and choose these 7 powers, and if the person doesn't have the ability to do any of those, then you can just do a general conservatorship, which is just basically you have a conservatorship and the conservator has the rights to make all the decisions. Limited conservatorship, you can pick all the powers and they pretty much have all the rights, or they pick and choose which powers they think that person has the capacity to manage. So again, this is a very important decision to make because getting a conservatorship is becoming quite a challenge, even for those people who absolutely need one. If they go with a limited conservatorship, the regional center will have the right to issue a report whether they think it's reasonable. Regional centers have decided on their own to never allow for social, sexual, and marriage. For some reason, they think that person with a disability should have those rights, even if they completely lack the capacity to understand what those rights mean. So again, it's a challenge, it's expensive, but once you get it, you get these papers called letters of conservatorship that will let you make all those decisions on their behalf. So again, it is the most restrictive way to get legal protection. It's the most easily enforced because it has the court behind it. Okay, so when I end with my parents, I kind of talk them through what do we need to do here to get where you need to be. So we talk about thinking about where are they going to live, what kind of care are they going to need? Do you think a conservatorship will be necessary? Who else is involved? Is there siblings, family members, friends? Are we going to have to go somewhere else, like a professional, to assist with all of those things? What kind of lifestyle is desired? Because sometimes people end up in a facility for the rest of their life. Some people are like completely opposed to them ever being in a facility. They want them in the community and they want to spend as much money as necessary to keep them in the community. And so we have to consider all of these things. I mentioned the special needs trust is the best way to do this. And so that's where we sit down and we kind of hash out what needs to be in that trust. Again, I always like doing a standalone living trust, revocable by the parents, irrevocable once the parents have died. Beneficiary can never have the right to revoke. Always ask them to do a memorandum of intent. Again, this is what helps family members, the trustees, and everyone figure out what do the parents want? How do they want this money used? It's a really good roadmap for how to do that. Usually by this point, the parents are like, well, geez, how much money is enough money to leave in a special needs trust? This is where you need those financial advisors. And a lot of them can run like Monte Carlo simulations that say, given these parameters, there's how much money you're going to need. But you really need somebody with special needs experience because a lot of times it's like creating a retirement plan for an 18-year-old. Because remember, they're disabled. And part of that definition is they're disabled enough that they can't go out and work and earn money. So we need to make sure that we have enough money in this trust that will last them for their lifetime, given, what the parents want for them. Do they want a house, caregiving, and all that? Do they want them in the community? Are they going to put them in a board and care? How is it going to be managed and how much money is going to be needed? And usually then, if there's not enough assets in the parent's estate, oftentimes they'll go out and get insurance, usually whole life. You don't want term because that usually doesn't pay. Again, we also talk about signing advanced healthcare directives, powers of attorney once they turn 18. And then if they just don't have the capacity, that's where we discuss conservatorship. I mentioned also that if they have assets of their own, like let's say an uncle left them $50,000 in their own name, you cannot put that $50,000 into this third-party trust we're creating because it doesn't work. It's first-party money. And so you either have to create, you could put some of it into an ABLE account up to 19,000 if no one else has funded it. But that's if it's 50,000, that still leaves, 31,000. So if we have that, then we need to make sure that they could put it into a pooled special needs trust or a D4A special needs trust. These are different kinds of special needs trusts that have different requirements. One of the big ones is it has to be for their sole benefit, which usually isn't that big a deal. But the other one is there's a payback to the state Medi-Cal agency on their death from those trusts. So if they have money of their own, we have to use one of these other techniques. We can't use what we've discussed today. I have a couple books. One is, how to create a special needs trust. Nolo Press has, it's a very bare bones trust, but again, I've done a lot of these seminars over the years and found that many times when families want to get a trust created, they don't like my fees. This does provide for a special needs trust and how that's managed and how it can be established. Plus, I created an administration book on how you properly administer one of these trusts. So these are the two books. And if you do want, I do have a monthly newsletter you can get from my website, herblaw.com, and then there's a special needs news. So let's see. All right, so we have some questions. Who do you recommend appoint as trust protector? So generally what I do is I don't appoint a trust protector. I create the position and then I say if a trust protector is needed, I have the advisory committee appoint a trust protector. And the advisory committee is usually the family members and friends. Sometimes they only have one family member they trust to serve, and I may just, instead of having an advisory committee, I'll just name them as the trust protector. Is food a qualified disability expense? I think that generally, yes. I don't think it's going to be a problem if you pay for food out of your ABLE account. Okay. Ooh. Please explain how lawyers who win cases against slumlords can protect damages. Boy, that's a long one. Let's we'll come back to that. What about HIPAA? If you have advanced healthcare directive, do you still need that document? Generally, no, but I usually prepare it anyway, just as an abundance of caution, because again, just because you legally may not need it doesn't mean that some hospital or medical facility doesn't demand that you have one. So when I create an advanced healthcare directive, I also do the HIPAA release that goes with it that says they have access to confidential medical information. So if somebody's eligible for both CBD and SSI, please discuss SNT. I would create a special needs trust, even if generally I would create a special needs trust, even if they qualify for CBD benefits, meaning we don't care about their assets most of the time because the person with disability rarely has the ability to manage their own funds. And setting it up into a special needs trust will allow somebody else to manage their money for them. It also provides some creditor protection against the beneficiary. It provides protection against predators and undue influence. But if the person with disability shows that they can manage all that, they're on CBD benefits, which means they're also on Medicare that primarily pays their health care, and they have Medi-Cal. I could see a scenario where we wouldn't necessarily do a third-party SNT, but that is so rare that I just don't see that very often. Okay. So there's some very lengthy questions here. I'm going to suggest you see my email. It's kevin@urbatsch.com. I'm right up to our last minute here. So if you have these lengthy questions, please feel free to email me and I will do my best to respond. Do I know of any resources in Spanish about SNT? I mean, I have multiple staff who speak Spanish that we have some translated, or sometimes we do the translation if they need that. It says, if there's no trust advisory committee or trust protector, how can the trustee be changed when the trustee doesn't want to step down? That's one of the big problems. Usually it's written into the trust document, the how you transfer from trustee to trustee. But if it's silent on that, then they can only be removed for cause. And cause is very hard to prove. You have to prove that they're either stealing from the trust or they just completely stopped serving as trustee, and which is very difficult to establish. So again, it's very hard to get rid of a trustee in a trust unless they're stealing or doing something completely against the terms of the trust. Is it okay to pay Lyft trips a few times a month by allowing the person to use my credit card number for Lyft? Absolutely, not a problem. That's a very easy way to do that. You can let them use it every day if you'd like. Okay, so I think we are 1 minute over, and I thank you all for your attention. I hope this has been helpful. Again, email me if you have any questions.